In the past, when the oil and gas industry began an upcycle and companies were flush with revenue and cash flow, they would invest in exploration and production and increase their production. But this time around, that's not happening. Companies are making money hand over fist, but they are not investing because they're worried about the energy transition. When is peak oil demand coming? What will be the market for gas? And that's led to problems of supply in Asia, where demand is growing quite rapidly. So I'm going to talk to Angus Rodger, who's the research director for Asia Pacific for Wood Mackenzie. Welcome to the interview, Angus.
Thank you, Markham. Good to be back.
So how big a problem is this in Asia?
At the moment, it's a relatively small problem, but it's getting bigger and bigger. I can see very big problems looming on the horizon, because if you underinvest today, it doesn't necessarily impact supply today, but 5-6 years down the line, suddenly you see these big shortfalls. And it's particularly interesting given what's happening around the world with different security supply concerns. These subjects should be front of mind, I think, for many governments in our region and across the world, in fact.
Now, you say the energy transition has affected, the way investors and financial community is looking at hydrocarbon supply. And what's the problem there? Is it high emissions? They want to make sure they don't get into carbon intense production. What's the issue?
Well, there's a couple of things. So you've had an oil price crash in 2020, and then you had COVID, and that made oil and gas companies incredibly conservative in terms of their cash flow. So even in places like the US with tight oil and elsewhere across North America, players have really pulled in their horns and decided, we need to be much more resilient in the face of down cycles and these incredibly traumatic market circumstances. So that was factor number one, that's kind of making them stick their hands in their pockets and not take them out again. And then we got the energy transition really accelerating through that period. And now you're seeing huge companies, oil and gas companies, BP, Shell and others, and the NOCs following their footsteps, saying, we're going to slowly try and transition out of being pure upstream players and become energy players and move downstream into power and utilities and renewables. So those two factors combined have made the upstream world a bit of a depressing place to be in many ways.
What role is decarbonization and climate risk playing? Because we've heard now for more than a few years, people like Larry Fink at BlackRock, that if you're not addressing climate risk, if you're not lowering your emissions, you're not going to get capital. And is that playing a role?
Yeah, it certainly is. And I think that train's left the station now in terms of the message going loud and clear to oil and gas companies. They must decarbonize, they must change business models, or their access to capital markets will slowly become restricted. Now, there's always capital available. Coal is in a worse state than oil and gas by far. There's still capital available to coal companies, but it's much, much more restricted. It's much smaller, and it comes at a higher cost. So there's far fewer banks who are willing to lend in the coal sector. Virtually all the major banks are kind of out of coal. So if you look at coal and think, could oil and gas go in that direction? The answer is certainly yes. However, it's dangerous when you lump oil and gas companies together, because oil is such an essential part of the transportation industry, and gas is seen as a bridging fuel to get us away from things like coal towards renewables. So it can be tricky to demonize it too quickly when things like gas are really, really important as the building blocks to kind of help us decarbonize, even though it is a fossil fuel. So it's a bit complicated, but it's a fascinating place to be at the moment, because all this is happening. Company strategies are evolving really, really fast as various boards and executives are going, where do we sit on this spectrum? How fast can we change? How fast do we want to change our business model? And of course, what do we have to do to retain, as your original question, access to all this capital that's so important to us, and access to shareholders as well, as Larry Fink and others have made their direction of travel very clear as well.
Now, you're suggesting that it may be counterintuitive, but it might be time to actually talk about incentives for oil and gas companies to increase production, despite the fact that they're making record profits. Could you explain that, please?
Yeah, it does seem somewhat counterintuitive, I agree. So there's a couple of points here. First, oil and gas companies are about to get a wall of cash that's coming in because commodity prices, gas prices, oil prices are very high right now. So without a doubt, we're going to see some incredibly high profits. These companies are leaner and meaner than they were before. So they're going to have to make far more money now than they ever did at $130, $140 oil. So they're going to have a huge amount of cash coming in. And what are they going to actually do with this money? And as you mentioned earlier, a lot less of that is going to go to upstream investment than previously. Now, a lot more of that money might go back to shareholders to try and maintain that favor in the markets. A lot of it will potentially go into renewables and the pivot to the energy transition, but a lot less of it will go into upstream. So then, to kind of answer your question, if you're a government, and particularly those in Asia where we're seeing upstream investment not necessarily trickle down, it may be that oil and gas companies are making big profits, and it may be they'll be reinvesting that capital in some of the best places, which might be somewhere like the Permian, but that money is not coming down to Asia and the upstream situation here. So you need to compete for that capital, whether oil and gas companies are making big profits or not. You still need to compete for that capital, or else it just won't come.
Now, the production, oil and gas production in Asia is on a downward trajectory, and you're forecasting now that the shortfall is almost 5 million barrels of oil equivalent a day, and you're saying that if things don't change by 2040, that'll be 17 million barrels of oil equivalent a day. That's quite a shortfall. And is Asia in danger of, the kind of energy crisis that Europe is facing right now?
I think so. That's the trajectory we're going on. I mean, there are slightly different. So the numbers you just mentioned there, that's purely in terms of gas. So the region is pivoting towards having a lot of domestic sourced indigenous gas, its own gas being produced. That is maturing and declining. And because all that gas infrastructure is in place, it's just pivoting to buying LNG and importing LNG from big LNG players like Qatar, for example. Now that's fine. That's happened in Europe as well. The difference is Europe is a developed market and energy requirements have pretty much flatlined, and it's also relatively wealthy. So they can pivot to buying LNG from Qatar or whatever. That's not a big problem. In Asia, the energy demands are rising really quickly, and we have a far less wealthy population. So you've gone through a situation where in places like Pakistan and Bangladesh, where they used to produce lots and lots of cheap gas, that cheap gas is gone. They're now buying LNG internationally. A few months ago, that was $3 per MBTU. Now it's over $30 to $40 per MBTU on the spot market. That's not what they signed up for, and they can't afford that, but they still have to pay that to keep the lights on in the country. So that is a real warning shot across the bow to governments that if you are going to, rely very heavily on imported LNG, you're at the whim of market forces. And what's happening across the world, particularly in Europe, is a sign of what can happen when it kind of goes a little bit wrong.
Is there any chance, Angus, that the high prices for LNG and for gas will spur the transition over to renewables or electricity in general?
I think definitely that conversation is being had. It has served as a bit of a wake-up call, not just in Asia, but across other countries as well. That, does this supply shock mean, not only does it mean we have to think harder about maintaining the lines of domestic supply, does it also mean we should expedite the transition? Do we just make the big leap and try and go all in, all chips on renewables, and just try and make that system work? Unfortunately, I don't think we're there yet. I think that the intermittency of renewables generation, as has proved in the UK recently, where the wind didn't blow, and so they didn't have any wind power, you need backup. And we don't have the battery technology that can sufficiently of scale yet. So that's where the role that gas in particular can play. In Asia in particular, you've got coal to gas switching, get away from coal, replace it with gas, and then the intermittency of renewables, you need that gas to back it up. But the role of renewables in the overall energy mix, I think, because of what's happening, will grow because it's a domestic industry you can invest in, and you're not necessarily reliant on international supply chains.
Final question, Angus. In your release, you talked about low-cost, low-carbon oil and gas that can be rapidly commercialized, advantaged barrels, you called them. And does that mean now that we're going to see a premium paid for advantaged barrels and maybe disadvantaged barrels may just stay in the ground?
We're actually already getting there, to be honest. So in the LNG world, we now have green LNG. So that's LNG cargoes where the gas produced is relatively low carbon, has a low carbon footprint, and it may have been offset by, say, nature-based, such as planting trees. So that is a greener cargo of LNG, and we're seeing buyers in North Asia like Japan, they're willing to pay a premium or have signaled they will be in the future to buy greener LNG. So already that's a signal to the market that buyers are going to be more discerning going forward on how clean their hydrocarbon is. They want to be able to have sourced. It's a bit like fair trade bananas, for example, at the supermarket. They want to know that the product they're buying is cleaner and more kind of ethically sound, if you like. So that's or just happening in the LNG market, but I can see that rippling throughout developed markets, pipe gas markets, places like Canada and the US as well, where your end user, your end buyer, let's say it's a power station or a chemicals company, they want to know where that gas has come from and how carbon intensive was its production. So that's, again, definitely the direction of travel I see the oil and gas industry going in over the next couple of years.
Is that likely to be market driven or regulation driven, or maybe a combination of the two?
I think it'll be market driven. I think it will be a combination of consumers being more aware and also the buyers, so the power companies, also under pressure to decarbonize for the same reason the oil and gas companies are. They need to prove to the capital markets that they're doing all they can to be cleaner and to be greener and doing all that they can do to make the planet kind of decarbonize. So that pressure is going to come down to the producers. And if you're producing in inefficient ways with high CO2 levels and you're venting that, or you're flaring lots of hydrocarbons, that business practice is going to be recognized and you're going to have to clean it up because the end buyer isn't going to be wanting to buy the product off you. If they are, they're only going to do it at a discount because it's a dirtier product.
Angus, thank you very much for this. Always appreciate your insights.
Anytime. Thank you.